Tēnā koutou katoa. Ko John McLeod o no JBWere's Philanthropic Services team or very hard acts to follow, I think, both the video and I've never had anybody sing to me at the end of a presentation, so really well done, fellow Aussie. Look, my job today is to talk about the charity sector in New Zealand, where we think it's going. I've been doing this role for about 18 years now in Australia and in New Zealand, really looking at the big trends for both the charity sector, for philanthropy, for impact, and we're starting to see some issues, I guess, emerge, and it's good to know those and look at what the solutions may be to some of the problems. So I always like to start my discussions with putting the charity sector in the context of what our economy looks like. So any country, New Zealand, Australia, wherever you want to go, is really made up of four areas. It's individuals, how we live our lives, it's government, it's all the businesses, and it's the charity sector. And too often we don't put the charity sector in that same context with the others, but if you look at the numbers on there, they all end in billions of dollars, in fact tens of billions of dollars. And it really says that the charity sector as a whole is almost as large as a number of those other sectors. And of course that's only valuing the dollars that it spends, not the social return that it gets from it, and that's something that I'll come back to as a theme when we go around. So we really only value charities for the amount they spend, not the cost savings, not the benefits that they produce. The other thing on here that you should look at is the dot points that are on there and how they really strongly connect each of those other three sectors back to the charity or social sector. So there's a lot more interaction there than most people feel, and I think it needs to be talked about a lot more in the broad public. I really don't believe that the public has a good understanding of how important the charity sector is to the way we live our lives and the quality of our lives. And that's a message that it's in fact dangerous if we don't get that out more broadly. So looking at the New Zealand sector, first thing I'd note is that there's a lot of charities. This chart here for each of the individual charity sectors looks at the growth in the number of charities from 2010 to about 2016. And you can see the tremendous growth in all of the sectors there, some larger than others, but all the sectors. And one of the scariest numbers on there is that first dot point where we see 2.5 new charities start every single business day over here. So if you think of the competition for the things that you're doing and the funding, whether it be from government or philanthropy, there's a lot of other competition around. In Australia it's no better. We see 10 new charities start every business day over there. So that's a bit of an issue. If we look at it another way, and this number here is for Australia, the concentration of the number of charities as well. So if you look at the blue line there, you can look at the number of charities that we have per population. So in Australia, for each person, there's about, for each charity, there's about 420 people. That's really concentrated. New Zealand, it's even more so. You've got one charity for 170 people in New Zealand. So that's a lot of charities there, doing perhaps some similar things in some areas. So that is an overall issue. Another thing that's very relevant for the charity sector is the degree of incumbency from very large charities. So this is an analysis we did over in New Zealand that looks at the year of establishment on there. The lowest dot, so closest to the bottom axis there, is your largest charity. As you move up vertically, you get the next biggest, the next biggest. So this is your top 40 charities in New Zealand, and it just shows when they were established. So you can see there that only about 1/5 of them were established in the last 20 years. A lot have been going for a very, very long time. And you might think, what's wrong with that? It gives a lot of incumbency to those charities. So when both governments and even funders look to support charities and people choose where they leave bequests, things like that, it's the big well-known groups that get all of the money and continue to do that. So I guess my question, if I'm looking at the for-profit sector and I look at the largest companies in any of the indices over time, we see them change. So 20, 30 years ago, it was the big car companies in the States. Then it became GE. Now it's Facebook and Google. Where are the Facebooks and Googles of the charity sector? We just don't see that. And there are some reasons for that that we'll go into. Just to show you that it's no different in Australia, that don't worry about the names, but that column on the left there are the top 20 charities in Australia 20 years ago. Column on the right's the top 20 today. And the bits that are coloured are exactly the same names. In fact, the only change we've had with new charities coming in to be the large names is in the aged care sector, where we've seen a big growth in the number of charities in that sector. But pretty much other than that, the names are still all the same. That level of incumbency as well amongst the big charities really is also focused on who gets the money. So if we divide the charity sector up into 1/10 of numbers in New Zealand, and it looks exactly the same in Australia, the blue bit is the top 10% of charities. And you can see how much of the assets they own and the money that they get. And the next bit is the next 10%. So if you fight your way around and you're in the bottom 1/5 or even 1/2 of charities, there's not much money to go around. There's not much in the way of assets there. So it's really concentrated, and that's a problem in bringing through new ideas. It's not a sector without a lot of assets. So the charity sector gets a lot of income annually, and they've built up a lot of assets over a long period of time, most of them in those large incumbent charities that have been around for a long period of time. That's not a bad thing in itself. Generally, having more assets is good. I'm sure all of you would agree with that. The issue is perhaps that over time, the assets that groups have got have perhaps moved a little bit away from what their mission is. So a lot have built up very healthy asset bases of perhaps property, and maybe that property isn't located in where their mission now resides. Maybe property is not the best thing to have for your mission these days. It's just built up over time. One of the examples we use, and it's a fairly simplistic one for this, is if you think of universities, today around the world they occupy brilliant pieces of land, beautiful bluestone buildings or other stone buildings in lots of countries. And in 25 years' time, I wonder what the university sector will look like. One of our early speakers talked about educating people with IT these days rather than going to campus. Universities, perhaps in 25 years' time, are the 30 or 40 best lecturers around the world sitting somewhere doing everything online, massive online learning courses. So the assets perhaps can move away from your mission, and that's something to be certainly wary of. The levels of income for the sector have continued to go up over time, and that's a good thing generally. One of the issues, though, that we see is that the income growth, and it's the same in Australia as here, has become even more skewed towards government. So governments have outsourced things they used to do themselves. They've outsourced them to charities, and they pay charities to do it. So the money the charity sector's got's gone up, but what they need to do with that money has gone up even more. So what we've generally seen is a squeeze on the margins in the sector. And that's a problem in itself, but it's also why we don't see the Facebooks and Googles of the sector. There's no extra money left for innovation and risk-taking and trying new things that perhaps might produce radical solutions. We don't see the margins there, and so that over-reliance on government and under-reliance on self-earned income does lead to those other issues of that lack of innovation that we see in the sector. It's also the big guys again getting all the money, and the big sector's getting all the money. So if we divide up the total funding that comes to the sector, you can see there it's really dominated by education and health, as it is in quite a lot of other countries. So if you're down in social services, welfare, those sorts of areas, the level of funding that you've got in that compared to other sectors that get it is quite low. And if we talk about philanthropy, so the giving of money by populations or wealthy individuals or bequests or corporates, who gets the money is a bit different. So now we start and see that it's not health and education that get the money, religion, basic religious charities. So these aren't charities that do welfare, that have a religious base. These are charities going to church on Sunday, Hillsong, that sort of thing. It's the largest donation charity in Australia and or sector rather, in Australia and over here. So it's around 20% of all philanthropy, and that's very similar in most countries. Same in the States, as I mentioned, in Australia. And you move down from that, and you can see the other sectors there that get it. Now, what we are seeing is a trend in a decline in religion getting that dominant area. In the States, it's gone from 50% of all philanthropy to now 30%. Australia, it's gone from 40 to 20. So there are opportunities for all those other causes to take some of that share as we perhaps move away from that being our major cause. The other thing to do with philanthropy that's, I think, fascinating is different sectors rely on philanthropy a lot more. So if I'm in the international aid game, so World Vision, Oxfam's plans, all of those, 3/4 of their money comes from philanthropy. It's only 15% of the overall income for the sector, but some sectors are extremely reliant on it. So for them, they live and die by their philanthropy. And you can see down there other sectors, you can see social services down there, about 15%, which is the sector average for their reliance on philanthropy. So where does philanthropy come from in New Zealand? About half of it is the mass market. So a lot of people giving a smallish amount of money annually each year, up to $1,000, something like that, $500 to $1,000. So a lot of people giving a small amount of money. The other sources over here, bequests. So like Australia, New Zealand seeing the baby boomer bulge move through, not for Maori, as was talked about, but for the other population. And it's about 6% of all philanthropy. One thing that you do have that very few countries have are your statutory trusts. So we've mentioned the individual ones on there, or the individual sectors. That's a unique situation for New Zealand, and it's wonderful. If they hadn't been set up, your philanthropy wouldn't look anywhere near as healthy. One thing that's quite small is the corporate sector over here. In Australia, it's up to certainly over 1/4, almost 1/3 of all philanthropy. Over here, it's quite small, and I think there are some reasons for that I'm happy to chat about later on. But I think it's a big opportunity for the sector to engage more with the corporate sector because it's not that well represented over here. So there are opportunities if that's done right, and I will touch on that a little bit more. Similar to a number of countries, that mass market that was 50% of your philanthropy is sliding. A lot of that's to do with cost of living pressures. A lot of it is to do with, I think, reputation. The reputation of charities around the world has reduced along with every other institutional group and government. And so there's a little less trust around for those sorts of things. Still fairly high relatively, but certainly falling. And I think that's why we've seen that level of support for the charity sector from the mass market slide away. And that is an issue going out, given it's half of all philanthropy here. When we look at a couple of other things around philanthropy, the costs of doing it. So the costs of raising money, just look at the line in the middle there in the purple or blue, whatever that colour is, the one that's going down. That's the rate of return you get. For every dollar you invest in raising money, it's how much you get back. So 10 years ago, 15 or 14 years ago, it was 10, 12 times. Today it's under 5 or around 5. So it's still a good returning investment to invest money to raise funds, but the trend is not good at all. And that comes back to that more difficult to get money out of the mass market. It comes down to competition between charities. If you've got that many new charities every day, the competition to raise funds continues to go up. Looking at different sorts of fundraising, I think is interesting as well. So this chart on here looks at the return that you get from different types of fundraising. A lot of people, when they go to fundraising, head to the right-hand side of that chart. So it's let's put on an event, let's send letters out, let's run an art union or a lottery. While that's a popular way of doing it, and you can get good volunteer support. It's not a great way of making money. It's not that great a business model. So some of the areas on the left there perhaps can use more of a focus there as a better returning way of raising funds. I've just got a couple of quick charts on the corporate sector. As I mentioned earlier, the corporate level of support in New Zealand for the sector isn't that high. I think there are some reasons for that. A lot of it's been put to me that a lot of corporates are based offshore and so do their support back home. But that's really belying why corporates should support the charity sector. They should support it because it enhances their business. It's not pure philanthropy when corporates do it. They're looking for some sort of win-win. Shared value is the big buzzword on there. So for charities, trying to understand why corporates might do it and then speaking that language to them is a much better way of engaging. And both charities and corporates are at a relatively early stage of learning this. But if you Google shared value, you'll come across untold number of Harvard articles around it talking about the ways to approach that and analyse it. So I think there are some real opportunities in rejigging the way that corporate discussion goes. The other thing that's interesting is there was some analysis done in Australia very recently, a big survey of corporate giving, and it's very interesting to look at the different causes that corporates support. So from large businesses on the left to small and medium enterprises on the right, the sorts of causes that they support are quite different. And so again, really understanding what corporates are looking for, what you're looking for, and trying to find that win-win situation, I think does have a lot of upside there. But it's not a matter of, let's go to the biggest corporate because they've got most money, find the one where there's a natural link. We've talked a lot about income. Let's talk a little bit about costs in the sector. So in the sector here, this is the where costs are going within all of the charities over time. Now, one of the sad things is that the growth in costs over time has exactly mirrored the growth in income. So again, we see no margin growth there at all. We see about 40% of costs going on employees. In Australia, it's 50%, hasn't changed for 20 years. So again, we come back to the innovation. If I was in a for-profit business, and they by no means have all the answers, but if I didn't see my major costs changing over a period of 20 years, I'd probably be looking to re-examine, where possible, some ways of doing that. And so that's an interesting observation there. Talked about employee costs being a big part of it. Of course, you get about a third of your employees for nothing. They're called volunteers. In Australia, it's about a quarter, so it's a significant part of the operating model for a lot of organisations. And one of the issues around volunteering is that in a lot of Western countries, in fact most of them, it seems to have peaked. It's time pressures, it's the difficulties in volunteering these days, you know, the forms you have to fill out, the children checks, all the rest of it, while absolutely necessary, are putting people off volunteering. And so given it's a very important part of your cost base, and you don't pay a lot for it obviously, it is an issue looming, I think, for the sector. So rethinking volunteering is something that's absolutely necessary. And we talked a little bit about margins before. The line on there shows in percentage terms the margin over a period of time. While it has its ups and downs, certainly the trend in margins in the sector is getting cut, and that's that over-reliance on government, no innovation capital, etc. Ugly table, but the only couple of things I want to highlight here are, this is a comparison with all of your numbers to Australia. So Australia, New Zealand is about 20% of Australia in most measures there. The areas that really stick out from this are the assets, so fourth from the bottom there, your charity sector is actually richer than ours in terms of assets, so I come back to how well are those assets linked to the mission. And the line directly below that, the number of charities. We have a crazy number of charities. You're one level above crazy in terms of the number of charities and the competition for that. So I'm going to finish up on a slightly different theme here, and that's around what are the other opportunities for the sector. And I know during the period of the conference there's a number of people talking about social enterprise, impact investing. We prepared a significant report for the Social Enterprise World Forum that was held in Christchurch late last year. There were 1,600 people at that. I was the oldest by about 30 years. So there's a lot of energy around social enterprise impact investment. And one of the reasons of that is it is an exciting area. The other reason it's really necessary. And it starts to reduce that over-reliance on government. So it's businesses that can produce a social return and a financial return. One of the reasons we need it is this balancing situation here where the demand for services is much larger than what governments can afford to continue to provide to the sector. So it's that other solution that we need. Now, where this starts to get interesting is if we look at the boring investment world. So I work for an investment management firm, JBWere, and we manage a lot of people's money. We do all that very well, I would say that. But around the world, the big trend in investment management is let's add an element of sustainability to it. So it's not just a few people wanting to leave out tobacco stocks these days. What we find globally, out of the $100 trillion in global stock markets and bond markets, a quarter of that today is managed with some sort of sustainability overlay. So whether it's just leaving out bad stuff, whether it's including environment, social governance in the way they analyse, whether it's impact investment, social enterprise, it's a really growing trend for mainstream investors. So they're actually looking for projects that a lot of you potentially can supply, and that's for the charity sector broadly. The problem at the moment is there aren't that many projects that are both financially good. Socially, they're generally good. The financial returns are the bit that needs the work. But there's a lot of clever people looking at that. And you've developed a national advisory board in this area very recently that we've been a part of as well. So growing trend, but one that's potentially the long-term solution for the sector. And I guess really it's saying every investment that you make, everywhere that you spend your money has got some measure of social return along the bottom axis there and financial return on the vertical axis. So if you just give money to a needy charity, it's got really high social return, pretty lousy financial return because you just don't get the money back. If you invested in big horrible companies that do bad things but make lots of money, you're right up on the top left of the chart there. But there are a selection of projects out there that are being worked on that do sit in that sweet spot that provides you with both a social and a financial return. And the more charities can perhaps start to think of that being a part of their arsenal, the better, and it really reverses what's a little bit of a dangerous trend going on. No need to read through all of this. This is just to highlight all of the lines down there are the UN's Sustainable Development Goals, so all 17 of them. The green bars on there are the connection to those Sustainable Development Goals that impact investments have. The really thin little blue and red bits there are the connections to the sustainable goals that the stock markets have. So they've got a little bit, they provide some jobs, they make some good stuff, but if you're really trying to get much more social impact and a financial return, it's really around the impact investment areas that can achieve that. That's why I think we are seeing this growing trend of investors saying, look, we'd actually like to see a social return as well, and perhaps moving away from some of those mainstream investments. So it is a positive trend. The other thing that's been really interesting about that trend is if we look at what sort of causes people are creating projects in, we've now got quite a period of data for that. We didn't have the breakup in 2012, but what's happened is impact investment, social enterprise, in the past we were really talking about microcredit loans. That was the big thing, the Grameen Bank, Muhammad Yunus, etc. Today, if we're talking about it, while that's still significant in the green area on there, housing has overtaken that. Energy, solar, renewable has overtaken that for where investments are going. So there are some big opportunities in those more mainstream areas where people are looking to invest their money to produce that social return as well as the financial return. But equally, If you look at all of those other areas there, you're all going to touch at least one of those areas on there in your social activities. There are great examples out there of the different sorts of projects that are producing both those. This is just a little example of a whole range of different asset classes, so from safe income type asset classes to private equity to real estate, real assets, and across a range of causes. And it's just trying to show you that what we're seeing today is this table's being filled out. For investors, there's suddenly something that they can invest in education that's an income type asset. In environment, that's a long-term private equity type asset. So there's a lot more options being developed. So it really is an opening up field. And there are just some pretty pictures because I haven't had any pictures yet, and I like charts, so someone said I should throw in some pictures of some. I do love charts. So some examples of investable projects that are out there across a whole range of things, be it from health to international aid to environment. So it is one of the trends that's heading out. So very final thoughts from me, and I thought I'd try and catch up a little bit of time since I know coffee's waiting for you outside. I do think it's really important to continue talking about how vital the sector is in terms of the overall country, not just let's box off the charity sector in one small box, but included in how connected it is to the rest of it. So that argument about self-interest, it's actually better for me if the charity sector's working well. So my life is enhanced. It's not just the people that we're helping or environment that we're helping. My life's enhanced if hospitals are better, if education's better, if art galleries are better, all those issues. So bring it back to the self-interest argument. We are seeing a blurring of lines between the for-profit and the not-for-profit world. So that blurring, I think, will continue, and social enterprise is a big part of that. It also allows much better access to a large growth in capital that perhaps isn't available to the sector right now. One of the big things, and it's one of the final messages I'll leave you with, is we still really don't value the social side of it. And I mentioned at the start that if the charity sector spends $1, we value it as worth $1. We don't value it as the full social return that it's having. And in a lot of the studies I've seen, the problem with that is that we say, well, if we spend $1, it's worth $1, let's just do that next year or the year after, let's put it off. If we wait a year in spending $1 in the social sector, it'll cost us about $1.25 next year to do it. So there are big incentives to really value that social, value that extra 25%, and that starts unlocking a lot more capital if we can put financial values on that. So finally, thank you all for hearing me. Any of the stuff that we've had up there is on the JBWere website. You can download reports for free that have both this cause report and that Social Enterprise World Forum that I mentioned earlier, the report from that. But thank you.